All right, so here we are. This is the last chapter that we're going to be learning because chapter 14 is actually going to be another fictitious business that you get to practice learning everything that you've learned between chapters um, basically 2 through 12. Or 2 through 13, excuse me. So again, that's what chapter 14 is. It's just another simple business that you can practice your QuickBooks with. So again, I'm not going to go over that just because that takes up a whole entire day, and I really, really want to go over the certification test prep questions. So we'll go over that, and then Wednesday, for whatever you want to do, maybe if you want to do chapter 14, we can go ahead and do it. So
Okay.
let's go ahead and go through this. So again, this is the last chapter of actual material that you actually need to know. So again, this is going to be learning about the adjustments and how to basically close out your books every year. So the reason why we close our books out at the end of a given period is usually to determine one or two things. One is to determine profitability, but also the second thing is to make sure where we're at in where does a business stand at. Is it profitable, or is it lacking something, or is there something that we need to increase, such as marketing or whatever it is. It allows us to take a stop, a minute for a second, take a look at what our business have done so far, and make a conclusion. Do we need to do more for our business, or do we need to do less for our business? So again, you have those two reasons. One, to obviously measure profitability, right?
Hmm.
And the best way to measure profitability is, again, we talked this very briefly, but this is what we do in accounting, is that when you close out your books, you're generally going to be closing out your revenues and your expenses, because that right there is a perfect measurement of how our profits work, right? Did we make enough money to cover all of our costs that comes to take to that we need to incur in order to run our business? So that's the perfect measurement, and that's why we need to make sure that we do these necessary measurements to ensure that when we close out our business, that we are looking forward to doing one or the others. Okay, so first things first is we're going to be looking at how the general journal is created. So again, down below, we'll give you a list of reasons why you would need a general journal. So we learned that you can use a general journal for recategorizing classes. So, for example, remember when we talked about our expenses and our revenues, right? If we did not assign them to our particular class, like, or a particular location, then our profits and expenses, they're all going to be all over the place. They're going to be slightly off. Okay, so that's one way you can use a general journal for. The other one is in case you accidentally placed a value in another account that isn't supposed to be there. So if you need to recategorize your accounts, you can do so as well. But for most primary reasons you would generally use a general journal for is to allocate any prepaid expenses, okay, and also to enter in any non-cash transactions. And we'll talk briefly about this, about a non cash transaction. So again, we talked about how we deal with bad debt, right? That's considered a non-cash transaction, because did money really move from one account to another? Did we really get paid for writing off our bad debt? Did we really lose that money? We never received cash in the first place, so that's going to be considered a non cash transaction. So depreciation falls under that category. And depreciation comes in with when you purchase fixed assets. So if I purchase a machine, or let's say for this example, I buy a printer, right? If I open up the box and I start using it and start printing everything, what can you say about that printer? It's going to lose its value over time, right?
Right.
Because you used it, right?
Hmm.
The wheels are going to be rusted, or the ink jets are going to be all dirty and whatnot, splashed and whatnot. The rollers are going to, you know, get all dirty and splashed off with ink. So there's a lot of things that comes into play when when you make a purchase of a fixed asset and you use it in the company. Again, there are some rules that we have to learn, such as the historical cost is the day that we purchased it. So if I bought the printer for $250, it has to remain in my books as $250 until the day I dispose it or I sell it. Now, of course, let's say I bought it in 2015, and it's fast forward 2020. Can you expect that my $250 printer is going to hold its value for 5 years?
No.
No. You use the crap out of it. You got to change the ink jets. Maybe the paper trays are not working, etc., depending on how often you use it. So again, with that being said, there's a term called depreciation where we need to come into factor to be able to decrease the value of our assets over time. All right, and that's going to be considered a non-cash expenditure. Other things too is also to close out the owner's withdrawal from the equity account. Okay. And we also learned too that in chapter 12 that you can use a general journal if you know what you're doing to enter in open balances. So those are the general rules of thumb when you're dealing with a general journal. Okay, so we're going to take an example here. So down below, we're going to go ahead and do an example of recategorizing our accounts. Okay?
Okay.
So first things first, there's only one location only in order to do this. It's going to go up to your company on the menu bar, and you're going to scroll all the way down until you see make general journal entry. Okay?
Okay.
That's just one way of doing it. You can enter it in as a register, which I'll talk about in a second, but you need to create an account in order for you to keep track of your journals here. But for this, I'm going to go ahead and show you how to do it first to enter it in, and then if you want to modify it for any reason that you need to, you may do so afterwards. But the first thing here is we want to make sure what usually happens when you do your general journal. So of course you could do your general journal at any given time, and this is for, again, people who have the accounting background, because this is what's going to really help you understand how a transaction really works. Right? You need to have the equal amount of debits go into an equal amount of credits. It explains what a transaction does. Right? If you need to make a payment to something, then you're subtracting money, but you're making a payment to an expense. So it makes sense. All right, so here the example says that we need to make sure that this journal entry is going to be as of January 31st of 2019. Excuse me. All right, so January 1st, 2019. January 31st of 2018, okay? Your general journal can be anything as far as here. They do want you to have it as 2019-1. You can make it whatever reference number that you want to. For me, I would prefer you write like adjustments -1, or you could do 2019-1, right, to make sure that you understand that this is the first general journal as of 2019.
Right.
All right, whatever reference number you want to be able to keep track of everything. Okay. So the first thing that we're going to do is we're going to enlist our first account, which is going to be journal entries. Okay. So what is journal entries account? This is going to be where you're going to locate all of your journal entries. All right. in this case, that's how QuickBooks does it. They create a bank account and they named it General Journal Entries because essentially they are meant for non-cash transactions. So instead of actually applying them to actual accounts that are actually affected by real cash, that's why they placed it as a bank account. This is for your non-cash transactions, but it's also a place so that you're able to locate your general journal entries quickly, because most cases what's going to happen is if you don't enter this in, you're going to actually have to find your general journals located all the way at the very, very bottom of your chart of accounts, which I'll talk about in a second. But in this case, they want you to place it into an account called General Journal Entries so that you're able to locate them quickly. All right? This one has no effect on the debit or credit side. This one, you do not enter anything in that account. Okay?
All right.
All right? So the first thing that we're going to be doing is, so we have to follow the rules of how the General Journal works. So in this case, in order to properly journalize an entry, you need to follow the guidelines where your debits are always going to come first and then anything that's a credit is going to come last. Now in this case, QuickBooks is pretty straightforward. They're not going to be super strict on you. However, you should try to follow that same guidelines because you never want to enter your credit in first and then do your debit in second. However, of course, because we get to locate where each item is going to be and tell it what to do, you can do it out of order. But general rule of thumb as an accountant, you need to be able to make sure that your entries reflect exactly what the accounting principles do. They tell you that you need to journalize your debits first and your credits afterwards, okay?
Okay.
So in this case, we need to debit our account. So here in this specific case, right? We paid for rent expense, right? But rent expense is not just purely just rent. We actually paid for both the rent and the utilities. So in this case, we're going to separate a small cost to place it into utilities. Okay? And then we're going to be taking it out of the rent expense. So when we made a payment to rent, we covered both utilities and rent. So in this case, now that I'm coming back here and I'm modifying the actual amount, right? I'm actually going to separate the utilities expense and place it into utilities because I accidentally forgot and I just paid the whole entire bill accordingly to rent expense. So in this case, I'm dumping a portion of the money into utilities and I'm taking it out of my total rent expense. So in this case, your numbers must match 100% because if they do not match, QuickBooks will not allow you to enter this transaction. So let's go ahead and take a look. So let's say, it's $25.62, right? But let's say I accidentally fat fingered it and I put $28.65, right? Check this out. It automatically calculated that, hey, you have a discrepancy of $3.08, and it will not let you continue forth because you don't have an account for that $3.08. So therefore, you have, there's something wrong. It's out of balance. All right? Because I accidentally fat fingered this number. So it will not let you continue on unless you actually have the difference of the $3 in another account. In this case, we don't. I accidentally fat figured it. So in this case, I have to actually fix this and modify it so that it goes back to $25.62. And therefore, this number here is going to recalculate and reflect as 0. Okay? And then, of course, the memo here is we are recategorizing expenses. Okay? And just like how this has the same commands, you can copy this like Control C, and you're able to paste it in each account here, just like that. All right, so here I made my modifications. I have my stuff here, and I placed a memo note for all of them, and that's exactly how you do it. So this is my journal entry for 2019-1, and I'd be able to go ahead and click save and close. All right, then it's going to give me this window, and I'm just going to, it says right here that the journal entry, let me see, transaction requires an account on each side. But in this case, I don't, oh, I have a discrepancy. Oh, okay. What?
Well, you had a discrepancy, but shouldn't that have gone away?
It should have. It's supposed to reflect as 0. So in this case, I don't know why it says that. So I'm just going to clear it out. If I clear it out, it should say 0. There you go. 0 on each side. Alright, and I'm not going to, there you go. 0, 0, 0, 0, okay? And I could go ahead and click save and close. And then I should get that beep of approval. That's what's supposed to happen, not that error message.
Okay.
So once I've done that, now the question is, where are my journal entries? So again, if I go to my chart of accounts, it's going to be under the bank account journal entries. Okay, so if I double click on it, it will pull up a register. So as you can see, the last entry I placed in here was my 2019-1. And if I would need to modify it, I just double click on this transaction and it'd be able to show me right here. So again, you're able to enter in the transaction again by using the register, but again, it's going to be a little tricky because you're not able to see your debit or credit. So you definitely want to go through the company preferences and make your general journal entry that way first, and then come here to either modify it, fix it, or whatever you need to do. But as again, like, your best bet is to not use the register and just directly go ahead and use the company and enter in the general journal entry here. Okay? But you are able to locate them using the journal entries bank account. Okay? Now, if I were to scroll all the way down to the very, very, very last page or of the chart of accounts, stop clicking. Okay. Nope, still clicking. All right, so here, notice this. You have a few things like purchase orders and you have sales orders, right? And look, it says it's categorized as a non-posting. So if you did have a general journal and you didn't place it under journal entries, it will automatically locate down here as that. Or if you'd like to, you can create a chart of accounts and actually say journal entries, and it doesn't have to be a bank account. It could be a non-posting transaction. But then again, it is a posting transaction because it does affect your company at large, where a purchase order doesn't really. But that's the general location. Is if you didn't create a bank account in the first place, it's going to be thrown down here at the very bottom, and it whether you categorize it as one of these items, right? It will show up at the very bottom of the list. Okay. But of course, QuickBooks or this particular scenario, they suggest you that you should, if you want to create a bank account, so then you can keep track of it right here. All right. Any questions in how to do a general journal?
No, it goes pretty much like what you were just saying.
Yes, pretty straightforward. The only difference is that when you actually do this, you're probably going to have the most hardest time because you don't have the accounting knowledge to be able to understand which transactions go where, how do you journalize this, etc., etc. But if you do have any questions, of course, you probably would most likely have to talk to your accountant about how to go about it. Or if you really want to, you could go on YouTube and check out any accounting 101 like videos, and you'll be able to learn and get a broader aspect of everything. So if that's what you really want to go towards, then definitely learning the accounting section is important, especially when you're dealing with the general journal. So you need to understand what transaction is going on and why are you doing this and why are you not doing this. Okay.
Okay. Okay.
All right. But as far as that, if you're okay with learning that itty bitty part of a general journal, then that's it for this section.
Oh, really?
That's it for this. That's it for this section. Yeah. So
Okay.
again, general journals are meant for primarily two of the things, and we just actually got to take a look at moving recategorizing accounts. So again, when you're dealing with bad debt, that's going to be considered one of those non cash transactions. And that's going to be an adjustment entry. So that's what I was talking about in chapter what was bad debt? I think that was chapter 2. Or chapter 3, sorry. Chapter 3 is when we write off bad debt. That's where you have to come after you've created your allowance for doubtful accounts and you've created your bad debt expense. That is where you're going to actually enter in a journal and you're going to journalize bad debt expense and you're going to write it directly off of the allowance for doubtful accounts.
Okay.
Okay. So that is that. Okay. Okay. Other than that, now we're going to be taking a look at using the $0 check. $0 check essentially is the same thing as writing a general journal entry. However, the only difference is when we look at our general journal, notice this. I'm going to go ahead and go to my journal entries once again, and I'm just going to pop up a random one. Notice this. What do you have here? You only have accounts. Okay? So that's the difference between the journal and the $0 check. A $0 check allows you to be able to utilize items. Okay? So in this example here, we're going to take a look at how to recategorize our items in case we accidentally wrote a sales form and we completely wrote it for the wrong item. So in this case, I'm going to go ahead and click on my write checks window, and I'm going to ensure the first thing I have to ensure is that that I am making a this $0 check. I'm going to make sure that it's coming out of my your journal entries. You're going to get a window pop up and you're going to say, do not display this message again. Okay, so here we are utilizing the journal entries account. All right. Okay. And for your reference number here, again, if you remember what your adjustment is, because usually your adjustments should happen all at one time at the end of a given period before you start closing your books out. So this has to be done, and we'll talk about that when we get closer to closing the books. All right, so 2019-2 is going to be my second entry. And again, it's going to be for the same, actually, in this case, it's going to be for February 28 of 2019. And here it says it's $0. And what you're going to do here is it's actually going to be for $0. So here the vendor or the payer that we are making this check out to is for Wong & Son. There you go, Wong & Son. Okay. And because here's one thing that we actually forgot to do. So I'm going to write here recategorize items. Okay. Let's say in this case, it says that I'm going to write a check to this, right? No. In this case, I actually misplaced a sales form and I accidentally wrote that that they purchased they purchased a retouching photo session when in reality they actually had a video person. So in this case, we need to type in photographer. Okay, oh, I'm on the wrong account. I need to click items before I go do that. So items. So items, they actually purchase a photographer. Okay, and I believe it's for 90. Quantity is 1, and it's for $95.
Right.
Okay, so we have to change this one to 95. Okay, and because we charged them, okay, just make sure you click this and click OK. And here we actually charged them for a retouching photo services, which isn't what they wanted. So retouching is what I originally charged them for when it wasn't supposed to be. Okay. Okay, so retouch a photo retouching services. So again, they purchase one of those, which is for $95. In this case, you need to make a negative. So it subtracts out from the retouching and it dumps it into the photographer. Okay, does that make sense? So you're essentially okay. So because we charged somebody. We charge them for one retouching when in reality they're supposed to get a photographer. So here we're essentially moving one item into another item. Okay? And here, again, by adding this negative number, because we're subtracting it out from the retouching to move it into our photographers, the amount should always retain as 0. Okay, so everything looks good, and I'm going to go ahead and save and close. And again, I'm recategorizing the items, and I'm going to go ahead and save and close.
Okay.
Right, and then again, if I go to my journal entries, right, because that's where I located it. All right, I can pull up that $0 check right here for Wong and Son, and it will show me that I moved items. I moved retouching items into photographer item. Okay. And that's it. So that's the difference between a journal and a $0 check. $0 check allows you to recategorize your items versus where the general journal only allows you to use accounts only. Okay, but the general journal allows you to do more than just recategorize your accounts. It allows you to recategorize your class. It allows you to also recategorize anything other than that. Okay?
Okay.
Save and close. Okay? So now that we did that, any questions in regards to the $0 check?
No.
Okay. All right. We're going through this actually pretty quickly. So let's see what the next section is. Next section is editing, voiding, and deleting. So with QuickBooks, it makes it so easy to edit any information. Now, there are some consequences and some things that you may have to ask permission for when editing a specific transaction. So again, if your accountant allows you to edit, modify, or delete transactions, which if you remember when we set up our users, the accountant can deny you having permission to make any changes to the transaction. But QuickBooks, it makes it so much easier to be able to fix your transaction. So again, editing transactions if it proposes to be something that you need to fix, like such as if I fat fingered a number. Those minor changes, you don't need to ask permission for that. But, in some case, if the accountant did lock your file up, you may need to ask the accountant to either fix it for you or to allow you to have access to make that changes. Okay? But in this case, we're admin in this case, so we can change anything that we want. So whether we fat fingered something, again, it's easy. You just double click on the transaction and just modify it as is. So for example, right, if I want to modify this general journal entry, I can just go in and modify it, saying, oh, never mind, it's actually not $25, it's actually $28.50, right? That means I gotta modify this too to $28.50. And I just can go ahead and click save and close. And it's going to say, do you want to make changes to this transaction? Yes. Right? Easy. You can edit any piece of information on QuickBooks without even thinking about anything. Alright? That's how easy it is to access the files and manipulate them whenever you want. Okay? But there are some rules and some things that you should know as part of the ethics section of accounting. Okay? Ethically, making changes to any type of transaction could propose fraud. Alright? So that is exactly why its general rule of thumb is that most cases, oftentimes if when you have the if you are not given the access to change, modify, or delete transactions, reason being is because if you have too many people being to have that privilege, anybody can change transactions at any given time. So yes, they can insinuate fraud. They can manipulate fraud without anybody knowing, right? So that's actually one of the reasons why the accountant, the accountant's role is so big and so important, is because you want to make sure that you try to avoid making any changes or allowing access or permission for other people to make those changes to the minimum, because you don't want to propose any fraud or any changes along the way that may, you don't want to, in this case, we call it cook the books. I don't know if you've heard that, where you have someone make a whole perfect accounting spreadsheet but hide all the bad stuff, and you cook the books so then no one ever finds out. So that is going to be where that comes into play. All right, making sure that you minimize the possibility of fraud. So general rule of thumb here is that this section here where it says that you can edit, void, and delete transactions, general rule of thumb is never do it. Seriously, because of that reason. Never, especially when it comes to deleting your transactions. You never want to delete anything because of that big, huge scare of possibility of fraud.
Yeah, there's always a paper trail.
Yes, always a paper trail. Okay? However, we're looking at the accountant standpoint. If you fat fingered something, yeah, you should definitely modify that. You should definitely edit that. If you forgot to attach something on a sales form, which is the exact example that we're going to do here, yeah, you better go fix that. Right? You don't want to cause your company problems in the future if you forgot to write something into your invoice, and you end up having the customer pay for less amount when truly that was your mistake. So again, always, 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 if you are the person in charge of whatever it is and you make a mistake, fix it ASAP, whether you have permission or not. And if you need permission, ask your accountant, okay? Just say, I forgot to enter in this transaction, so I need to charge my customer a little more. So in this case, that's exactly what we're going to do. We're actually going to go ahead and click on create invoices. And sometimes this works, sometimes it doesn't, depending on the file. But if I go ahead and click previous, right, it should show me my last person that I have, which is Maria Cruz. Okay, Maria Cruz branch opening. Perfect. For invoice number 2019-106. Right? This is in case the last person that entered this transaction, you'd be able to fix it. But let's say you know this exact person, then you can locate them, the exact transaction in the customer center. Alright, but in this case, it's the last transaction that I just completed. So in this case, I actually forgot to also enter in additional information. So I forgot to enter in that I have to charge them for the outdoor photo session. Okay, and that they wanted 3 hours worth. Okay, so again, by doing this, again, we have to modify my memo. So in this case, we got 3 photo packages, okay, and 3 outdoor photo sessions, right? Some of them are kind of pretty straightforward, right? How can they order a photo package when they didn't even have a photo session with us, right? So
Right.
some things are a little kind of clear. Some or things that you have to like what is it? You have to assume. Um, but in this case, this person just ended up forgetting to write this in, or they were just it was like 5 o'clock or 4:59, and they just want to get out of the day out, and they just entered this in, and they completely forgot that they're supposed to charge more than that. Yeah, but in this case, if you've already sent this invoice to your customer, make sure you go ahead and write a notification, right? You have to actually write a letter saying, I am sorry, you requested this, so here's your updated and new invoice. And you're going to have to send them a brand new one. And you're going to have to avoid the first one. But in this case, I'm tacking on to the original invoice, not creating a new one. So in this case, you have to tell them that this is going to be the revised invoice. So most cases, what happens is that you should also actually indicate that in the actual sales form itself, because you made changes to this. Again, if you sent this person the invoice already and then you forgot to tack on that extra thing, or your customer says, I thought I was supposed to also get 3 hours of photo sessions, right? Depending on your customer, if they're honest or not, they can tell you that. So if you do end up making revisions to your invoices, general rule of thumb is you need to make some kind of indications that you revised it. So in this case, I'm going to put R for revision. It's not mandatory that you place this information in there unless you feel that it's necessary. So in this case, I am putting that this is, I have trouble typing today. Right there you go. 2019 106R. R for revised or revision. Okay, this is assuming that I've already sent them the invoice and I'm canceling, or not canceling the transaction, just sending them a new updated invoice. So in that case, once I make my changes, I can go ahead, click save and close. And then it's going to ask you, are you sure you want to make changes to this transaction? You want to say yes. So now, again, so that if you did already send them that invoice, you're going to have to send them a letter apologizing and why you made these changes, and then send them a new invoice from there. Okay. All right. So just like as simple as that, changing anything, modifying it is as simple as that. You just do it. You select it and just do it. Yeah.
Okay.
Pretty straightforward. Okay. So we went over that example there. So here next is voiding and deleting transactions. So this one's pretty straightforward. All right. For any reason, it is absolutely necessary for you to need to void or delete a transaction. It's straightforward. So I'm going to go ahead and go into my, let's go ahead and go to my customer center real quick, right? And I'm going to go ahead and pick on Mr. Bob Mason, and we'll go ahead and take a look at his stuff. So let's see. Bob Mason, he owes us $1,177. So if I go ahead and pull up his information, right? And I sent him an invoice. For any reason, he's modified, made changes. Okay, so oftentimes you would use the void is if they canceled something. Alright?
Okay.
So that's like the only option that you would technically void a transaction is if they canceled on you. Okay, so in this case, here's an invoice, right? Because they ordered from us saying, hey, I'm going to order three photo sessions, retouching a photo package, and I want a picture frame, right? For any reason they decided to cancel on you would be the only reason why you would void a transaction. All right, so maybe, of course, you can always modify the invoice afterwards, because usually you don't send the bill until after the stuff has been completed. But let's say this invoice was from an estimate that you gave, because he said, I want all these things. I need you to be scheduled here for Wednesday, Thursday, Friday. Let's say Friday rolls around and he ends up missing one of his photo sessions because he fell sick. Then If you already have this invoice already, you can either modify it, or if you've already sent him the bill, assuming that the whole task would be done by Friday, then this is what you can do. You can go ahead and go with the edit button, right, on the menu bar, in the menu bar, and you can either void or delete the transaction. Okay? Void or delete. Okay? Again, general rule of thumb is never delete anything on here. Voiding is only just going to zero out the entire balance, as if this transaction has never happened. But however, the invoice is still going to remain. Okay? It's still going to remain that we have all the stuff. However, the only action here is it's been canceled. And then you either create a new invoice with the stuff that he actually purchased from us and continue on with that. Then yes, that's the proper way to do it. Okay? But for most cases, you wouldn't need to void any transaction at all. And more or less, you would never delete any transactions at all. Okay? But again, it's as easy, as simple as right clicking and be able to delete it here. Alright, in this case it's edit on the menu bar, and you can either void or you can delete it. Right? Okay. Same thing with a check, right? You can either void or delete the check. Again, rule of thumb is you never want to delete anything because it's going to leave holes in your accounting and etc. etc. But in this case, yes. Alright, so just as simple as that. General rule of thumb, you should never ever have to come to that conclusion where you have to do that unless the circumstances is they canceled on you. Okay? Or if you canceled on them. So for example, same thing can apply for if you ordered something, right? And you cancel with them. You have to notify the vendor why you canceled, obviously, so you can let them know. Okay? So then on their books, they can write that transaction off. Okay? All right. So now that we talked about voiding and deleting our transactions, again, they're just going to simply zero out your transaction. Nothing else. Especially when you void it, it's going to remain in your books, but it's just going to be zeroed out. If you delete it, it's going to be permanently removed off of your books. Okay. So, but, however, here's a catch to this too. When you're dealing with a QuickBooks book, right? The more we keep adding our stuff in here, and the more transactions that we enter in. So every time we enter in an invoice, right, we're just stacking upon, and adding more and more and more information in here. So as you keep adding more information, what's going to happen is your book is going to get super heavy. And when it gets super heavy, you're going to have a lot more trouble opening up the file. All right? And oftentimes if your file is too heavy and you have multiple people dipping their hands in it, you can automatically assume that the program's going to crash. Okay, same thing with any other program right there. If you have Microsoft, right? If you have 1,000 pages in one Word document, you can expect it's going to take forever to load, and you're going to expect when you keep scrolling down the pages, it's going to take forever it to appear. Not that it's lost or anything, but you can also have potentials of the program crashing or even corrupting the file itself. So the general rule of thumb is when you reach that point, right? You never want to have when you start your book, right? And you close out your books every year, right? But you maintain or retain all the information, right? Imagine this: if you've been doing accounting with the same file for 10 years, you can expect that it's going to be slow, it's going to crash. There's too much information on there. So if that's the case, the rule here is that yes, you can delete all of your transactions, right? Once you properly take the measurements to close up your books. Or the best rule of thumb is create a company backup. Once you've done that, then you can delete every transaction that exists in the book, but still hold on to all your lists, all your preferences, all your accounts, etc., etc. You can keep all of that information. But however, the only thing is your transactions are going to be wiped out clean. Okay? So this is really good and very useful, especially, again, when you're dealing with performing millions of transactions every day. So example, Walmart. How many transactions can you expect to happen in one day?
Don't even want to think about it. I'm sure it's astronomical.
Exactly. So you can only imagine if they use QuickBooks to do the accounting, you can only imagine that realistically they need to delete the transaction every day. All right, and don't not only think about that. It's going to be you may have to create one for each store location, or maybe from each state. There's a lot of factors that can come into play, especially with the enormous amount of people that have access to it, or the amount of people that are on your list. Right, you're gonna have billions of vendors. You're gonna have billions of customers. You're gonna have billions of employees. Right, so you can only imagine that your QuickBooks book is going to be super super heavy, and having a million transactions in there every day, the best way to keep your file like nice, concise, and clean is by deleting all the transactions and starting over every day. So in this case, that's exactly what it does here. It allows you to keep your lists, keep your preferences, and keeps all your accounts. All of those things are all going to stay intact. The only difference is every sale form, every invoice, every receipt, every bill, every paycheck is all going to be deleted. Okay? So how to do that is you're going to go up to your file on the menu bar, and you're going to click on utilities. And then once you do utilities, you're going to scroll all the way down until you see condensed data. Condensed data is what you're going to do. That allows you to collapse the information. All right. Now, of course, before you do that, first thing it's going to ask you is, did you create a backup? All right. That's the most important thing, is you want to back up your file before processing the rest of this information. Because again, if you don't back up this file and let's say, oh shoot, I need to see what my expenses was last year, you don't have it. You deleted everything. Okay, so once you delete, you cannot recover it. That's also one thing you need to know too. So make sure that you set a backup file just in case you need to go back to that file once again. And once you create that backup file, then you can proceed to deleting all the transactions that exist. So again, once I do that, you're just gonna read the book just exactly how it says in the book, and you're gonna click next, and so on and so forth. Okay. I'm not gonna do it because I have a few more things I have to show you.
Okay.
So I can't delete my information yet, but yeah, go ahead and just continue reading the rest of this, and it should show you the rest to do. Right? Pretty straightforward.
Yes.
Okay. So any questions so far? All right, so that means the next section that we have here is going to be memorizing transactions. So this is actually a fun one. So as we know, how tedious is it to have to come into QuickBooks and enter in the same exact billing information every single time?
It can be really bad, especially if you have a bunch of them the same.
Exactly, especially if they're identical, but the only difference is the date is changed.
Mm-hmm.
Then, having to click on enter bills, right? Putting in the date, putting in the vendor, putting in the amount. QuickBooks allows you to memorize specific transactions so that you can avoid having to enter everything from square one. And by memorizing a transaction, you can even automate it, where when that day comes, it will populate it and it will show up on your window saying, don't forget, we have a bill that you entered in. So awesome, right? So QuickBooks makes it so much easier to enter in, especially when you're dealing with fixed expenses, right? Such as rent. The bill is going to be the same. The only difference is your utilities, which that's not even what it's asking. It's not billing you for utilities, it's billing you for the rent expense. So that's exactly, or for insurance expense, right? And that's exactly what this example is going to say. Every month you got to pay into your insurance expense. Okay. So here is what you got to do. So let's go ahead and enter in this bill first. You have to enter in the bill first for it in order for you to save the transaction. So if I go ahead and go and click enter bill, all right. Oh, I think there. Okay, there you go. Okay, there you go. So again, I'm entering a bill. It's going to be for Sinclair Insurance. All right. And then I'm going to say here monthly insurance expense or whatever. Okay. And I'm going to go ahead and indicate that my account for this is going to be, of obviously, insurance expense. Insurance expense, right? And let's say, let's say for this month, right, as of, I believe this was dated for January 15 of 2019.
Yes.
Okay, so January 15, 2019, reference number, 2019, whoa, is it 101 or is it 1? I think it's just 1. All right.
It doesn't have a reference number for me on this one, but if we use the other one.
Yeah, it should be fine. Doesn't matter what it is. Usually because it's a bill, you would write technically your reference number is going to be whatever the billing number is.
Right.
Okay, but in this case, I'm just going to say 2019 1 because I don't know what it is. And then this is where you can go ahead and say it's $600 this month. Okay. By typing that in, it's going to fill in my information down below as the amount. Okay. And let's say this is going to be for, is it the San Jose location?
Looking right now. Again, it doesn't tell me in the book here.
Okay, that's fine because we can always edit and modify it. So let's just leave it. Let's say this is just random insurance expense, right? My memo, I'm going to say monthly insurance expense. Okay. And once I do that, right, instead of going save and close right away, I'm going to go up to the top. Okay. I can either go to edit on the menu bar and memorize this transaction, or I can just simply go right on top of the form right here and it says memorize right here. So by clicking on memorize, now it's going to say, well, what do you want to memorize this transaction as? I'm going to say the name is monthly insurance expense. Okay, I'm just going to name this transaction the way I see it. Okay, monthly insurance expense. Okay, now the question is, do you want to add this to your reminders list? No, I don't. Do I not want to remind me? It wouldn't hurt to not remind me, or I can have it automated. Automated means it's going to enter it in without me having to remember it. Okay? So yes, you definitely want to have it automated. Okay? The automated transaction entry. So what that does is every time I pop up, whether it's this particular person, right? It's going to automatically fill in saying, okay, if it's insurance expense, it's going to fill in automatically the information I placed already in here. It's going to fill it in as the account as insurance expense. It's going to fill in the date automatically for me, and it's going to let me know that it's going to fill in the form for me. So that's what I definitely want to do. All right. Now, here's another question. How often? Obviously, I want it every month because it's a monthly insurance expense. But you do have quite some options, okay? So again, if your bill is a recurring bill that happens, every other day, every other week, or an invoice even, right? Let's say you have this one customer that just loves to buy so much stuff from you, right? And they buy the same thing over and over and over again. Or they borrow you for the whole month and they're going to just keep buying you something from every single week. whatever invoice or transaction that happens, usually you can say it's a daily or whatever option that you have. In this case, this is a monthly bill that's going to be a reoccurring bill. And then it's going to say when's the next date that is going to be due. The next one should be actually not March, but it should be February 15th of 2019, right? A month later, you should be receiving the same exact bill, but on February 15th, a month later. And then they ask you, well, how many numbers of bills do you have left remaining? Since I received the first one, which is January, starting from February, that means I have 11 months more to go. And then it says right here, how many days in advance would you like to be notified for? Oftentimes, you can choose this so that it puts the bill in, so it lets you know a couple days ahead before, just instead of automating it automatically on the exact day. At least you're aware a couple days. In this case, I'm going to keep it at 0, and I click OK. Alright, it took a picture of this, and then now I can go ahead and safely save and close. Alright, so here's what's really cool. Let's say it's next month, right? I go ahead and click on that pay bills, and I type in Sinclair once again. Right, I type in Sinclair, and boom, it populated everything except for the amount number, because I never memorized this, right? I just said that the insurance is going to be different every month. Now, if I want to actually code it in, let's say it is February 15, and this is what, 2019 dash, I don't know, 6, let's say. If I want to save the actual number in here, I can actually go into the amount, and I'm going to go ahead and modify it. I'm going to say it's exactly $600. If by me typing this information and I go up and re-memorize it, right, and I select that it's going to be that same exact one, I'm going to click OK. All right, and then I'm going to save and close. Right, so then the next time I do it, right, and I do Sinclair once again, it should automate everything. Oh, okay. It didn't do it there. Okay, let me do this again. Let me do this again, okay? Okay. So here's what I gotta do. So in this case, it won't automate it there. But if I were to go here to my list, right, and I go to memorize transactions, okay, one more over, list, and I go to memorize transactions, okay, so I have 2 Sinclair so far. I have I have a monthly insurance, and I have Sinclair. So I'm going to click on monthly insurance and let's see what happens. By clicking on that, boom, there's my $600, okay. It automatically saved it, and it told me that it is due for the next day, which is the 15th. Okay, so rules here is if you modify anything, let's say I forgot to, or in this case, okay, let me do this again. So let's say that's my bill, right? I click no because I'm not gonna enter that transaction. Let's say I do need to modify it. All right. In order to modify this, I do need to right-click it and be able to edit the information. So edit the memorized report. So in this case, it gives me this little window to see what I want to modify it for. So again, I want automatic all this information, right? That's as much as I want to modify it for. So I'm going to go ahead and click OK. So notice this. I can't make changes to my report. However, let's say for this one, right? Remember when I created a second one? So what happens is that if I double click on it, right? And let's say I do place in the information, and let's say I forgot that this is for the actual San Jose location. Okay? If I make a modification to it, I would have to re-memorize it. And I have to go up to the very top and click on it here to memorize once again. And then it says right here, Sinclair is already in the memorized transactions. Would you like to replace it? Yes. I want to replace it. So that means the next time I look into this, again, see now my date has changed, right? Now it's March. All right, because I replaced it. Now the next time I do, okay, so I'm not gonna enter this transaction. So the next time I do go into the Sinclair one, it's gonna automatically pull up March because I didn't enter it in, and it's gonna be now updated with the San Jose.
Okay.
Okay. So every time you do this and you want to modify it, you're going to have to go through the memorized transactions report. Okay. And then it will give you the options to either replace it or make changes to it. So again, yes. So that's how you rememorize a report. So in this case, now I have too many, right? Because I realized I made too many copies. So what you can do is, I don't really like the Sinclair one, right? I already have the monthly the monthly insurance expense. So what I could do is I can right click it and I can delete my memorized transaction. Or you can go to the edit menu and delete it. In this case, it's as easy as that. Delete memorized report. Are you sure you want to really delete this? Yes, I do. And in this case, let's modify the monthly insurance. Let's say, again, it needs to be San Jose. And again, obviously the billing number is not going to ever be the same. It's going to be something that you have to type in all the time, so you can't memorize that. But everything looks good. It's $600, and again, I received it on the February 15. I'm going to go ahead and rememorize it, so the next time I open this, it's going to be for the next time. So then again, I come here, once again, double click on it, and now it's for March 15th, San Jose, $600, etc., etc. So if, let's say my rent expense went up, I can always modify it and replace it every single time. So that's what it makes it so much easier for you to go ahead and enter in all your information. Okay? All right, and that's how you memorize transactions. Any questions? Okay. Okay, so I'm going to go ahead and close that because, again, I'm not going to be entering in all that transaction. So again, editing, adding, deleting, it's so much easier. Once you add it in there, you can always delete it anytime. All right. Now, if you delete it from the memorized transaction, it does not delete your actual transaction, okay? It's just deleting the fact that you want it to be memorized. So in that case, you're able to delete anything on that list. Okay? It will not affect anything. So if I go to Sinclair right now, right? Because I entered in a couple bills from there, right? If I go to Sinclair, no, they're not a customer, they're a vendor. If I go to Sinclair, it's still going to show me that I have X amount of bills from them. Okay? Come on.
So when you set it up for automatic like that, does it automatically go into your checks that need to be written at the end of the month also?
No. Okay, so that's something that I need to talk to you about. So that's actually one of the things that is going to be one of those things. So if you go ahead and read this little box right here, it will tell you, wait, not this box, this is the first box. It will tell you right here. It can memorize invoices, it can memorize bills, but you cannot memorize a bill payment or receive payments or paychecks. Okay, so when you said that exact thing, that's considered a bill payment. So unfortunately, no. Because again, our options for our bills, right? Yes, that's the tedious part where we're going to have to actually go ahead and click the bill payment and go through all that stuff. But the initiative reasons why you can't memorize it is because one thing's first. You can make payments, as many payments, split payments, pay a portion now, pay a portion later. You're not subject to pay everything in full. Same thing with your customers. You can receive half payments. Right? Same thing with your paychecks. Obviously, you have to pay them, but you can't memorize them, right? Because especially with your employees, if they're on a hourly wage, you can't expect them to show up every day, 80 hours a day. They can get sick. They can take vacation. They can call holiday off, right? So they can call in any day off. So you can't expect that. Same thing with a salary person, right? They may not, just because you pay them the same amount every single time, you have to also adjust for anything extra. What if you had a side project that allowed them to earn more money? What if they got commission this month?
Hmm.
That's why the only thing that you can't memorize here is a bill payment, a receive payment, and a paycheck. Okay, that's the only thing you can't do. All right, any questions in regards to that?
No, I don't think so.
Yeah, so the only ones that you can do is like, again, a reoccurring bill, such as rent expense, or a reoccurring invoice, like let's say if you are a coffee shop, right? You have that one person that you know that is a regular customer that comes in every day and orders the same thing. That's going to be one of those people. Okay, so yes, all right. Okay, so now that we finished that section there on memorized reports, we talked about rememorizing, we talked about deleting, and we talked about editing. Okay. All right, we talked about deleting already. So, next section is going to be closing out the year. So, this is very important that you need to know. So, when we learn in accounting, okay, we learned that there's an accounting cycle, and in the accounting cycle gives you basically steps that you need to take, standard procedures that you need to do to complete within an accounting period. All right, and an accounting period can be determined, right, on how often you want to schedule to complete the cycle. All right, but also what makes it best for you, for your company, because the ultimate goal is when you close your books, your ultimate goal is you want to test for profitability, you want to ensure that your financial statements are completed, and you also want to make sure that you properly close out your books, so then when you start the next accounting period, everything is fresh. It's at zero. Okay, so again, I'm going to do a brief 101 right here. So the accounting cycle, there's 10 steps to the accounting cycle. First is going to be collecting your source documents. So, saving all those receipts, saving all those invoices, saving all those bills. Okay, which then the next step is going to be analyzing. How does it affect the company? All right. Third is going to be journalizing. So we just got to take a look at how to enter in a transaction, right? So every time we have a sales going on, great, we can record the sale. So that's a transaction, all right? And we have proof because we give them a receipt, all right? And that we get a copy of the receipt as well. So that's how we can measure that. Then the step number 4 is entering it into the general ledger to make sure that our account balances are reflecting, that we have a balance in each account, which again, you can find on the chart of accounts. Okay, and all this accounting is being done in the background. So the next step is going to be completing the trial balance, ensuring that your debits match your credits, ensuring that your transactions went through and that your transactions didn't go somewhere else. But that's also the time where you need to also make sure that you double check your work and make sure that each account is properly placed in their exact location. Then step number 6 is going to complete your adjustments. So again, maybe you accidentally placed an account that isn't supposed to be there, so you need to recategorize it. Right? Then, or you need to do any adjustments, such as adjusting for bad debt expense or depreciation. You need to lower your fixed assets because you used it a lot this month. All right? Once you
Okay.
complete that, 6 and 7 are right there. Then step number 8 is to complete the financial statements, which entails, right, completing your profit and loss, completing your balance sheet to make sure that your assets equal your liabilities and your equity. And you also have to complete your statement of cash flows. How much cash is actually flowing in your company, and how much cash are you actually spending from your company? Then step number 9 is to complete the closing process. So zeroing out all your expenses and zeroing out all of your income to reflect for the next period that it's going to reflect as zero, because we talked about this, right? By closing out your expenses and your revenues, that's the perfect way to measure profitability, right? By closing them out at a given period, you're essentially recalculating and readjusting your income and your expenses, because we have that notion where every income that you are expected, there's never going to be the same. This month you might have a high sale in your photo sessions because it's spring, or maybe in the winter it's low because it's Christmas time, or maybe it's higher in Christmas time, etc., or lower in the summer because no one wants to go out in the sun to take photos, right? Any reasons, right? Or and your expenses, right? Just because you have a reoccurring one, maybe this month I spent a lot of money to do advertising. Next month I decided to spend more money on working on a separate project. There's a lot of things where income and expenses will never match every single year or every single accounting period. So once you've done that, then step 10 is to complete the post-closing trial balance, which, again, you don't really need to know. So with all that mumbo jumbo I just told you about, that's how we determine how often we need to do this. Again, most cases, depending on your core operation of your business, if you're someone like Walmart, you're probably going to do it every day because your transactions can pile up billions every day. Okay? If you're a small company like this one, monthly is doable. Okay? It's unnecessary to have to do it every day. But again, you could do that, or you could do quarterly. So most people, like most businesses, will release quarterly statements and they'll release an annual statement. Right. So they could say, oh, in the spring, right, my sales are low because of the holidays, but my sales are super high when it hits the fall/winter section, because of course you got Black Friday, you got Christmas, you got all this where sales are gonna skyrocket, right? So that's an example right there. All right. So by completing this, the last step that you have to complete is that you need to, after you have your profitability, right? Your profitability is going to be converted into retained earnings. And what you do with retained earnings is two choices. You can either take the retained earnings and reinvest back into your company, or you can just leave that retained earnings for just in case you need it for some other reason. All right? But in this case, that's corporate talking, right? Corporations use retained earnings. Sole proprietors use income summary. All right? It's just terminology that's different, but essentially they do the same thing, because at the end of the day, if you choose to reinvest into your company, that means your retained earnings is going to or your profits, right? Your profits is your retained earnings. Your retained earnings is going to go be reinvested into your company. And therefore, again, we talked about what equity is. Equity is basically the value of your company. If you invest more money into your company, it will increase. If you took a loss, you have to kind of suffer in that and decrease your equity. So that's exactly what I'm explaining right here, is this section right here, is that QuickBooks will do it for you. You don't need to calculate anything. It will automatically take the retained earnings and automatically reinvest it into your company. So then when you do your next statement, or when you complete your next statement, at all given times, your profits are automatically calculated as your equity. Okay? All right. All right. Yeah. Okay. So again, here is going to be the steps that you need to take. So again, I briefly went over these steps right here, but this one is for QuickBooks, okay? So obviously the first one does say that you need to enter in any depreciation, so your adjustments. And then of course, you need to also reconcile your bank, which is chapter 5. And then, of course, if your business has inventory, you need to adjust your inventory, right? Chapter 8. So all of these are necessary steps in order for you to prepare to close your books at the end of the given accounting period. So again, in most cases, you can either measure on a monthly or a quarterly basis. Oftentimes, you're more likely to see something happen as a monthly basis. And again, you're going to be using you will be using your journal entries to go ahead and be able to adjust all things that you need to adjust for. And then you're going to need to create a closing date. So setting here, you're going to have to do your profit and loss, and then you're going to have to close your date, set a closing date. Okay? And then once you do that, then the last thing that you have to do is delete everything that you have in your files. So again, that's why it's important that you understand all of these things, because at the end of the day, every time you're at a new period, you definitely want to get rid of the old transactions so it doesn't throw you off. And second, it makes you keep in line with yourself. Okay? So with that being said, yes, those are usually the recommendations or the 10 steps that you should follow when you're preparing to close your books. All right, let me see if we're good on time. Good, it's only 2:45. So once we've done that, then we're going to start doing our closing entries for sole proprietors. So again, what we know about the sole proprietor is that you are able to invest your own money, but you're also able to take away money from your own company because you own the company.
Right.
So by having that one thing, if you are a sole proprietor, there is one more step that you actually have to take to fully process your work here. You need to close out your owner's withdrawal out to equity. Okay, so I'm gonna go ahead and do an example here. So we're gonna go off the books real quick. Okay. So first things first is we need to create an equity account. All right. So again, if I go into my chart of accounts, I'm gonna notice that my entire chart of accounts, my entire books, right? In this case, this is a corporation, right? We established in the very, very, very beginning of the year that this is an S corporation. Okay, so in this one we have retained earnings, etc., etc. But in this case, I'm going to go ahead and show you for this example so you can properly take it out if you are a sole proprietor, because most likely you are going to be, if you want to open up your own company or work for a small company, you should know those rules. So should we go over here and we can see that corporations, right? Pretty standard, right? You have retained earnings, you have capital stock, right? When you sell your stocks, that's how you get money. You have retained earnings. You have your okay, that's not equity, right? So in this case, I'm going to go ahead and create 3 equity accounts. All right, so this is the first thing that you have to do when you establish your company. If you are, starting out your company and you are a sole proprietor. So I'm going to go ahead and click continue. First thing I'm going to have is going to be owner's equity, all right? Depending on what kind of company you are, you're going to either be an owner's equity, meaning you're a sole proprietor, you're the sole owner of this company, a partnership, equity, meaning you have more than, you're a partnership, right? Mm-hmm. Other ones is stockholders equity. Again, you're not the owner of the company. Your partner's not the owner. It's the stockholders or shareholders, right? They own the company. So that's the difference between all 3 entities. But the essential rule here is the same. So here, I'm going to go ahead and enter in owner's equity. Okay? And I'm going to go ahead and click save and close. I don't need a description. All right? I'm also going to create a second equity, right? Second equity account. All right, but this time, this one's going to be capital contributions. Capital contributions is going to be anything that I choose to invest into the company. So capital contributions. Okay, so this is what I want to invest my own money into the company. Save and close. All right, and then lastly, the one that that affects equity as well is because we not only do we have the opportunity to invest in our own company, we also have the ability to withdraw from the company because that's just what we can do, right? In this case, I'm going to go ahead and type in owner's equity. All right. So now I'm going to go ahead and save and close. Oh, shoot. My bad. It's supposed to be owner's draw. My bad. Owner's draw. All right, and then click OK. So now here are my 3 accounts. So I have owner's equity, I have capital contributions, and I have owner's draw in here. Okay? Okay, so again, I didn't associate any account numbers on there. That's okay, because for this example, we don't need to have account numbers because, again, this is going off the books. So in this case, we don't need to have it. They're there, okay? So first things first is I need to have money in my equity account. So I'm going to go ahead and utilize a journal real quick, and I'm just gonna place money in there. All right, so again, this journal is going to reflect, I don't know, let's do February 15, okay, and let's just say I added money. So here is capital contributions, okay, and then of course this is investing into my own company, so I'm going to invest into my owner's equity. So in this case, when you learn about account balances, you're going to learn that it has normally a credit balance. And I'm going to invest with my own money $30,000. Okay? Wrong one. Come on, go over to credit. $30,000. Okay? You can write a check or deposit this, but in this case, I'm just going to do this really quick example here. So I'm going to go ahead and click Save and Close. Right? So if I were to go to my chart of accounts, my total amount of owner's equity should reflect as $30,000. So I'm just going to type it up in here. Okay, so owner's equity, I have currently $30,000 in my owner's equity. Okay, so let's say by the end of February, I decided, you know what, I deserve to take some money out of my company. So I'm going to go ahead and make another one. And this is what you have to do at the end of every given period, is that you're going to have to recognize this. So I forgot, you're supposed to do journal entries first, so then you can locate those later. So first thing I'm going to have is my owners. I'm closing out my owner's draw, right? In this case, I'm taking money away from my equity. And in this case, I'm also showing that I took money out, right? By owner's draw. Okay? Mm-hmm. Now, you can, of course, write a direct check, so then in your owner's draw, you actually have a balance in there. So I think that's what we're supposed to do first. We're supposed to write a check. Let me undo that real quick. So let's cancel that out. So I have $30,000 in my original investment, right? Okay. So first, I'm going to go ahead and write myself a check. Okay. I'm going to go ahead and write myself a check. Come on, write a checks window. There you go. I clicked on it a million times. It didn't work. So let's say, I don't know. I'm going to say Bob Mason is the owner of this company because I don't want to create the person. So again, in this case, I'm taking this out of my checking account because, of course, when you take money from your company, it is obviously clearly to from your checking account. You wouldn't take it directly out of your equity account. Okay, and I'm going to say it's Bob Mason, and I'm going to say this account is a owner's equity. Owner's draw, excuse me. Owner's I don't see the account number on here. No. It's an expense. Okay, because I'm on items, that's why. No. Okay, so go to expenses. So this is an owner's draw. There you go, owner's draw. So that means in this account, I'm taking money out, and I'm going to say I'm taking out $2,500. Okay? Save and close on the date. Again, the date will be the end of February. And I'm going to say, okay, save and close. All right, okay. Problem here is that another check, okay, has already been used, okay. Keep number cancel. So in this case, 330, I'm going to say 350. Or actually, let's do the 6,005. All right, and I'm going to save and close. Okay, once I got that beep of approval, let's go ahead and take a look at my chart of accounts now. So if I were to type in owners at owner, right? Okay, I have a amount for 2,500 in my draw account, and I also have 30,000 in my equity. So my equity hasn't changed yet. But what happens is, because at the end of the month, you have to do this because it's an adjustment, right? You took money away from your company. If you took money away from your company, it's no longer valued at 30,000 anymore. So this is where I'm going to go ahead and make my adjustment. So I'm going to say at the end of the month, again, I'm going to make my adjustment. So this is now my journal entry. Journal entries. And I'm going to debit my equity, right, at owner's equity. Right, because it's going to decrease it, and then I'm going to also take away from my owner's draw. So again, I'm going to debit this for 2,500, and I'm going to credit this for 2,500. Obviously, the description is I took money away from the company, so it's pretty straightforward by the owner's draw. And I'm going to go ahead and save and close. Now let's notice this. Let's look at this. Now my company is valued at 27,500. It's no longer 30,000. And my draw is now 0. Okay, so that's what you have to do when you are a sole proprietor, is that you are going to have to make this adjustment, because your company, right, I may have written that it is now worth 27,500. It's because I took money away from the company. Okay, so now my company is now worth 27,500 versus 30,000, right? Because I took money away. So that's how. So this section right here, this is how you enter in an adjustment, and you need to close out at the end of the period. Okay. All right. So that is that. Okay. So again, for most cases, so what this class is that I do teach for the actual accounting program is I do teach accounting as if you are planning to become a small business owner, so a sole proprietor. You have to start somewhere. You can't just be incorporated automatically, especially unless you are getting permission or being licensed to open up a chain, a franchise. Then that's completely a separate topic whatsoever. But for this class, I'm teaching it as if we are the sole owner of the company, and if you are planning on opening up a small business. So again, that's why I needed to teach you this, just in case you do go into the future and you are not going to work for a corporate business. You will need to know this particular part because the corporations is already done for you. The retained earnings is automatically reflected as your in your equity automatically. You don't need to do anything. But this down here below here is showing, well, what if you are a sole proprietor? What if you belong to a partnership, right? You have to distribute your the earnings amongst the people that are co-owners of the company.
Right.
Okay? So that's what the next section is, what you do when you have partners. Okay? All right. Okay. So that's what this is, distributing net income. So when you are a partnership, you have to split the profits amongst every person who is an owner of your company. So again, partnerships is not just only two people, right? You can have two or more people, right? To be in order to become a partnership, right? You can have someone who is a sole worker as a partnership, while the other person could be a silent partner, right? They're just a mere investment to you.
Right. All they're doing is placing money into the company with the hope of
Absolutely.
getting something back.
Absolutely. That's what a silent partner is. Okay? So then once you've done all of that and you completed all of those steps, this is where now you need to set a closing date. Now, setting a closing date in parentheses, just as right here, is you're essentially locking the data up. So again, of course, especially when you are the accountant, you don't want your books to be laying around. People have access to it at any given time. Once you've fulfilled your section where you've done your profitability, you did your profit reports, you made a conclusion that these are the sales for this month or these are the expenses for this month, you want to ensure that you lock up the data because you don't want someone to go in there, make a little changes in there, and then when you pull up that information once again, all of a sudden your profits all over the place, your expenses are all over the place, everything's going to become out of balance. Now, of course, QuickBooks is going to catch that, obviously, by saying, hey, you know, things are out of balance. Okay, but oftentimes that you want to do is, especially when it comes to other employees, right, you don't want them to give themselves bonuses or commissions or anything like that, right? So you definitely want to be able to lock up every piece of information, okay? And the only person that can do it is going to be the admin in themselves. Okay? So make sure that you know that the admin themselves is going to be the only person that can set the password to lock up the data, and they're the only one that is allowed to access the data. You definitely don't want to give permission to someone else. Okay? So again, in order to do that, in order to lock up the data, you're going to actually go to your company file, right? So there are a couple ways that you can do it, right? If you choose to set a preference, right? If you go to the edit preferences window, and then you go ahead and click on, I believe it's accounting, okay? You're going to be able to set the closing date right here. But in this case, if you don't want to do it that way, what you can do is you can go to company, and then you have the option to set closing date right here, set closing date. Once you do that, it's going to take you to the same window, right, to the edit preferences under the accounting. So again, this is where you set the personal information. Now, if you do set this, remember, you want to set it, obviously, the date after you're using this. Okay, so if I click set date and password, right? Now it's going to ask me, when do I want to lock up this file? Now, in your book, it says you want to do it December 31st of 2019. That means if I were to lock my data, the minute I set that as 2019, I can no longer use QuickBooks because we are in 2021. Okay? So you want to make sure that when you set the date, you want to make it far enough in advance to not automatically lock it up for you. So that's why, if you remember from our interview, it says to set a closing date. You want to hold on to that until you complete everything, and then once you're for surely ready to close your date, then you do it then. Because
Okay.
that way, you know, you don't lock yourself out of your transactions. Because once you set the closing date, you cannot undo it. Okay.
Okay.
So in this case, instead of uh 2020, right? If I do 2020, because right now we are in 2021, it's gonna lock me up too. So in this case, I want to make sure that I don't lock myself up for this particular example here. So I'm going to make sure December 2021, the 30th, first, is going to be set to date. So that means I still can work on the file as long as I want. Okay? But if I were to set it on 2020, it would have automatically locked up my files because I'm currently in 2021. And remember, all transactions that you deal or enter in here, it's automatically going to pull up today's date. So that's the one most important thing that you have to remember. Okay? So again, here now we set the closing date. Okay, so now it's going to set the password. So in this case, they want me to put ABC1 2 3 4 is the password. ABC1 2 3 4. All right, and then I can go ahead and click OK. Okay, so once I've set that and I'm finished and I do that, see, look, now it's grayed out, meaning you can never fix it. Okay. You can't change it, okay? Especially if you locked it up prior before this, you won't even have access to the file. All right? So once you've done that, you're going to click OK. So now that my date is set for December 31st, I can continue putting in my transactions until December 31st. All right? So once that's there, that's all you need to know. Always set it after the active date. So in this case, because I'm currently in the year 2021, I should keep it still active until then, right? So once you close your date, so obviously it's going to be the same exact, right? It's going to be the same thing as opening a portable file, except this time it's a working data file, right? And because everything's locked up, you can't edit, you can't do any transactions. And in order to access it, you have to enter in the password to go ahead and modify it if you need to. So that's what that password's for. So you can view the files, you can look, you can see all the transactions, you can run reports and do everything as normal, but you can't change it. That's unless you have the admin password to validate that you can make changes to a locked data file. And that's all that section is. Okay?
Okay.
And that's it for this chapter. Any questions on chapter 13?
I don't think so. A lot of it's straightforward.
Yes, and this was only 20 pages. So that's why we got to go through it very, very, very quickly. It's straightforward. Again, this would work a lot better if you got the opportunity to take the accounting class, but it's okay. So I don't mind explaining it first and then doing the example. So other than that, this chapter is really towards the people that have the accounting background. Okay.
Okay.
So accountants per se. This is the accountants chapter. All right, so let's go ahead and go over the review questions. So number 1, okay, which of the following tasks does QuickBooks perform, okay, automatically at the end of the year, or at year end in that case? C. It automatically adjusts the balance in the retained earnings, and it reflects it into the net purchases for the year, net loss for the year.
It doesn't make automatic journal entries.
No. That again, that's only for corporate, because retained earnings is for corporate, so it automatically does it for you. But if you are a sole proprietor or a partnership, you would have to do that journal entry in order to adjust it. So in this case, that's the only thing it does. It automatically does that for you. Okay. Number 2, okay? Okay, so entering a date into the closing date field accomplishes which of the following?
C.
C. It just locks up the file. Okay, that's correct. Number 3, okay, avoiding and deleting transactions both do the following.
Well, it doesn't zero out anything, so it would have to be. Maybe it. Hold on, let me think about that. Oh, it keeps A. It keeps a record of the date number.
Okay.
And
So here's what this question is asking. It's not asking does voiding do this or deleting does this. This is both of them. Okay, so deleting and voiding. So the first one is keep a record of the date, number, and exact whatever the details into the transaction. That is what voiding can do. Okay, deleting doesn't do that. It gets rid of it completely. Okay,
Right.
so the question is, what do both of them have in common? What do they, at the end of the day, what do they both do? So in this case, this is only strictly for voiding. B says it completely removes all details in the transaction. That is going to be deleting.
That would be deleting. Yeah.
Yes. C is actually going to be the correct answer in this case because obviously B and C, right? It's if B is already completely deleting, then D's the answer is going to be wrong. C says it zeroes out the debits and credits in a specified transaction. So yes, remember, voiding zeroes out the accounts. Deleting removes it, so it gets rid of the account itself. So it just pulls out all the information and pretends like it doesn't exist. So essentially, it does zero out both debits and credits. So C is the correct answer.
Okay.
Okay, so they both essentially zero out the accounts. Okay. Number 4, to make an adjustment to items as well as their associated accounts, create a what?
C.
C is correct. Okay. Now, now this one's a little worded a little weirdly because it can be confusing.
Because I was thinking I needed to do a journal entry first.
Yes. So okay. So in this case, yes, that's why I said this question is confusing because this is something that you have to kind of really know is when you create your items, they're linked to accounts, right? You have to create the account first in order to create the item. So that's what this question is asking. This question is asking, well, how do you, adjust items which are linked to accounts, right? So you would write a zero check entry or $0 check. But for a general journal is only accounts only. Okay, so if you're dealing with an item itself, unfortunately, you won't be able to do that in a general journal. You do not need to complete a general journal first in order to complete a $0 item. Okay, so in this case, you could do either or, but for this one, because it's specific to items per se, it is a $0 check. Okay? But the great thing about the $0 check you can do is you're able to do both items and accounts because you have the expenses tab and you have the items tab. Okay?
Okay.
Lastly, number 5, okay, at the end of the year, you should perform the following.
D, all the above.
All of the above, yes. Again, we talked about the very first step, right? Those 10 steps on page 407.
Mm-hmm.
First thing it says is you have to do depreciation. Other things that you have to, in the next couple steps, it tells you to do to adjust your inventory, take a physical count. And then, of course, see if you are a partnership, you have to split the profits amongst the people that, journal entry, and you split the profits amongst the partners. Okay?
Okay.
So, yes, D, all the above is going to be true. All right. So, that is it for chapter 13. So, let me see what you want to do. I'm going to go ahead. We're going to go on a break because it's, it's